What I'd like to talk about in this video is bond pricing. The next two slides, they're at the end of the present worth analysis presentation. I didn't really discuss them, but I want to talk specifically about how bonds are priced. Now, bonds are a financial instrument, and they're on the right-hand side of the balance sheet. They're under long-term debt, and the difference between a bond and a stock is that a bond has a life. Stock is perpetual, if you will. Bonds have a maturity date. And pricing a bond, and I did this in my work in industry, literally I issued billions of dollars of bonds for Union Oil Company. And I priced bonds all the time. So bond pricing is just simply a time value of money problem. Bonds are sold at face value, and so typically in units of 1,000. So we can just use a face amount of 1,000, and they have an interest rate. And interest is paid, and if it's a corporate bond, it's usually paid semi-annually. So every bond that I issued had interest paid semi-annually. So we borrowed money up front. We paid interest semi-annually, no principal, and at maturity, the face value was repaid. So we paid the amount that we borrowed up front, the $1,000, and we repaid that at the maturity date. However, bonds are like stocks. They trade, they're financial instruments. And the value of a bond changes over its life depending upon the interest rate. So let's look at an example right here, and I'll pop out into Excel and show you how it works. So we have a 15-year municipal bond issued 5 years ago. Coupon interest rate is 8%, paid semi-annually. The face value of it is $1,000. What is the bond's price if the market rate is 12%? So let's go out and I'll show you how this works. So when you issue the bond, what we know is that in 15 years, we are going to pay $1,000. In addition, we're going to pay 8%, and that's the coupon interest rate. Basically, it means it's 4% every 6 months. Okay, so it was issued 5 years ago, so there's 10 years left on it. So let's assume we're at an interest payment date. This is exactly the way that it's done in industry, except for if you buy or sell the bond on a non-interest payment date. Things get a little messy, but it can all be calculated relatively easily. But let's assume it's on an interest payment date. So we're going to have end of period, and we're going to have 20 periods. Okay, and so the reason we have 20 periods is there's 10 years left on the bond's life. And so end of period, this is today. Okay. And we're going to have the interest payment. And I'm going to hard code this in. Typically it would be, we'd have the coupon rate. So this is set on the day the bond is issued. We're going to pay 8% semi-annually, so it's going to be $40. And it doesn't matter what happens to interest rates. We're going to pay $40. And then we're going to have the final payment, so the final face payment. Okay, and that's going to be on the last coupon date, 10 years from now, we're going to receive $1,000. So whoever holds the bond is going to get this cash flow stream. And so it's just going to be $40 per period, except for the last period is going to be $1,040. Now, if we have we'll do a PV factor. Okay, and we're going to say the semi-annual rate. And let's just say the semi-annual rate is 4%. Then our PV factor is going to be 1 over 1 plus the 4% raised to this power. And the present value is going to be the $40 times the present value factor. And if interest rates stayed at 8% nominal, 4% every 6 months, the value of the bond is just the sum of these payments. And guess what? It's $1,000. And it has to be. If interest rates don't change, the value of the bond stays the same. But let's say that interest rates go up. Now, the problem says 12.36%. Now, if you go, you can see 12.36% is 6% every 6 months, compounded semi-annually. So it's 1.06 times 1.06. If I said my nominal rate was 12%, and it's compounded semi-annually, my effective rate is 12.36%. So my semi-annual rate, I meant to do a percent there, my semi-annual rate is going to be 6%. So if interest rates have gone up, now remember, these things, these cash flows are set in stone. We're going to receive these cash flows. So if interest rates have gone up, the bond is less valuable. It's paying 4%, but the basically 10-year rate now is 6% semi-annually, and the value of the bond is $770.60. If interest rates go down, So we're at 4% every 6 months. Let's say they went to 3%. We are receiving payments based on a 4% semi-annual rate, but the rates have dropped to 3%. The bond is more valuable. It's worth more than $1,000. So it's counterintuitive. Bond pricing is counterintuitive. Rates go up, the price goes down. Rates go down, the price goes up. Now one of the things I'm mentioning this today is because we've seen interest rates go up dramatically in the last year. And that's because inflation has gone up. One of the ways to battle inflation is to raise interest rates. Holders of bonds have lost money because rates have gone up, the value of these bonds has gone down. You would rather own a bond paying 6%, if that's what today's rate is, than a bond paying 3%, if that's what it was a year ago. So it's counterintuitive. Rates go up, bond values go down. Rates go down, bond values go up. So if we go back, and I'll post this Excel spreadsheet and underneath the video, we've already got these slides. They're in the present worth. But the value of the bond is $770.60 because rates have gone up. Now think about what that means. We issued a 15-year bond. Interest rates were 12% nominal. I'm sorry, 8% nominal when we issued it. 5 years have gone by. So the pricing for a 10-year bond today is now 12% nominal. So pricing for a 15-year bond, because interest rates tend to be higher the longer the maturity date, is probably even higher than 12%. Now these are canned numbers for a class example, but the principle works. In industry, when you do this, we're working with hundreds of millions of dollars. So interest rates only need to move 0.25%, and millions of dollars can be made or lost. And that's what bond traders do, is they trade interest rates. So hopefully this has been helpful. I think it'll be a little bit helpful for, I believe it's problem 6 or 7 in the homework.